What if I told you that a totally ordinary, honestly kind of boring amount of money could completely rewrite your financial destiny? We're not talking about a massive inheritance here, and we're definitely not talking about hitting the jackpot on a meme stock or winning the lottery. I'm talking about an amount that, for a lot of us, is just a car payment, a few dinners out, or a bunch of monthly subscriptions. What if a simple $500 a month was literally all that stood between you and absolute financial freedom? $1.75 million. Just let that sink in for a second. Imagine you're 25 and you make the decision to take that $500 and invest it consistently, month after month, year after year, right up until retirement. Over those 4 decades, you'd personally pull less than $250,000 out of your own pocket. Yet, depending on the market, your portfolio could potentially grow to well over $1 million. I know, it sounds like absolute magic, but it's really just math doing the heavy lifting.
Welcome to this explainer on the $500 million habit. I am so pumped to guide you through this today because we're looking at the actual mathematical blueprint for building long-term generational wealth. We're going to break down exactly how ordinary money transforms into extraordinary wealth. Okay, let's dive into this.
Here's our quick roadmap for today. We'll be hitting 1. The $1 million habit, 2. The snowball effect, 3. The cost of waiting, 4. Surviving the market, and finally, 5. Your wealth blueprint.
Let's jump right into section 1, the $1 million habit.
To really wrap our heads around this, let's look at a hypothetical 25-year-old investor. We'll call her Sarah. Now, Sarah makes a deliberate choice to set aside $500 every single month. If she simply saved that $6,000 a year by stuffing it under her mattress or leaving it in a zero-interest checking account, her progress is pretty straightforward. After 10 years, she saved 60 grand. After 20 years, 120 grand. And after 40 years of really disciplined saving, she's sitting on $240,000. Now, don't get me wrong, having $250,000 in cash is awesome, but saving alone just isn't the whole story. Saving protects your money, for sure, but it doesn't grow it.
To bridge that massive gap between $240,000 and $1.75 million, we have to introduce arguably the most powerful force in finance, compounding. Simply put, this is when your investment returns start generating their own additional returns over time. Basically, your money makes money, and then that new money starts making money too. It is literally the engine of wealth.
And that brings us perfectly to section 2, the snowball effect.
So if we apply a hypothetical 8% average annual return to Sarah's monthly habit, notice the shape of this growth. After 10 years, Sarah's portfolio is worth about $91,000. She put in 60 grand, so she's definitely up, but it's not exactly life-altering just yet. Honestly, this is the painfully boring phase where most people just give up. But look at what happens if she sticks with it. By year 30, it leaps to $745,000. And in that final decade, between year 30 and 40, it completely explodes to $1.75 million. Compounding doesn't work like a rocket. It's way more like a snowball rolling down a really long hill, just gathering more and more mass the further it goes.
Now, what's really wild is this tipping point. Imagine Sarah's portfolio has reached $500,000. She's still out there working hard to contribute her $6,000 a year. But if that portfolio gains 8%, it just generated $40,000 in growth entirely on its own. Suddenly, her money is working way harder than she is. The portfolio is doing the heavy lifting now.
But what happens if you put this off? Let's get into section 3, the cost of waiting.
Let's bring in Sarah's friend, Mike. He decides, you know what, I'm going to wait exactly 10 years before I start investing. So at age 35, he finally starts investing that exact same $500 every month, assuming the exact same 8% return. The difference is just staggering. At retirement, Sarah has her $1.75 million. Mike, he's got about $745,000. That is a clean $1 million difference. And here's the absolute craziest part. Over those 10 extra years, Sarah only contributed $60,000 more out of her own pocket than Mike did. Just 60 grand in extra contributions basically bought her an extra $1 million in final wealth.
The real takeaway here? The true cost of waiting isn't just the physical cash you didn't invest in your 20s or 30s. The actual cost is the decades of unearned, compounding, exponential growth that your money never even had the runway to achieve. Time is, without a doubt, the most valuable asset in this entire equation, way more valuable than your initial principal.
Okay, moving on to section 4, surviving the market.
It's super easy to look at a smooth, theoretical chart, right? But what happens when the market inevitably takes a 20% nosedive? Well, your $500 habit actually has a built-in defense mechanism, and it's called dollar-cost averaging. By investing on a strict schedule every single month, you're automatically optimizing how you buy. When the market is riding high, your $500 buys fewer shares. But when the market crashes and everyone else is completely panicking, your $500 naturally buys way more shares because everything is essentially on clearance. You don't have to perfectly time the market or predict the bottom because, let's face it, nobody rings a bell to tell you when a crash is over anyway. You just stick to the schedule.
Because the truth is, the market isn't the real enemy. The real wealth killers are things like quitting after a few months, panic selling when headlines get scary, or trying to chase overnight crypto riches. Unless you've got a crystal ball tucked away somewhere, trying to time the market is just a recipe for disaster. Real, sustainable wealth building is remarkably boring. It's all about ignoring the noise and sticking to the system. Boring doesn't make for flashy social media screenshots, but boring absolutely builds millionaires.
All right, let's bring it all together in our final section, your wealth blueprint.
Understanding the math is just half the battle. The other half is actually executing on it. And the secret isn't necessarily the number 500. It could be $50, $100, or $1,000 depending on what you can comfortably afford. The real secret is creating a system that takes all the guesswork out of the equation. So here's your framework. 1. Build an emergency safety net so you're never forced to sell investments just because your car broke down. 2. Tackle high-interest debt. Credit card interest will literally eat your compounding returns alive. 3. If your employer offers a 401k match, take it. That is free money. 4. Pick a monthly amount you can realistically stick to. 5. Choose broad, diversified investments like index funds or ETFs so you aren't betting your whole future on one single company. And 6. The absolute most important step, automate it. Set it up so the money leaves your checking account before you even have a chance to spend it.
Before we wrap up, I really want you to internalize the emotional timeline of investing. In year 1, your progress is going to feel entirely invisible. You'll honestly wonder if it's even working. By year 5, you'll start to see a little bit of momentum. By year 10, you'll be looking at deeply meaningful numbers. And by year 40, you will have completely transformed your financial life. Thousands of incredibly small, boring decisions eventually stack up to create an absolute mountain of wealth.
I want to leave you with this final thought. Think in decades, not days. Your goal isn't to be rich by next Tuesday. It's to guarantee that your future self has absolute financial freedom. So, I have to ask, are you going to keep jumping from trend to trend, hoping for an overnight miracle? Or are you finally ready to build the boring, unstoppable system that will quietly turn you into a millionaire? The choice is entirely yours. Thanks so much for joining me for this explainer, and happy investing.